I hate to say it, but I'm concerned about Tesla. Very concerned. I'm going to give you my thoughts in this video, and just because I'm coming across as a dirty, ugly, nasty, gross, bear, flip-flopper, I'll go ahead and put it on. All right, folks, I'm concerned, and I'm going to go through these concerns one by one. Let's start. First, I'm concerned that Elon Musk's Q2 push to generate an incredible Q2 to maximize his stock comp artificially reduced interest rates at Tesla and pulled substantial Tesla demand forward. This will make it harder for us to prove to Wall Street that we justify the valuation that we have today. There's much more to this. We're going to hit Robotaxi. We're going to hit Optimus. We're going to hit energy. We're going to hit a lot of research here. So buckle up. 0.99% in May, in my opinion, probably pushed anyone on the edge of wanting to buy a Tesla into buying a Tesla. The problem is now we're finding that 50% of buyers who have owned a Tesla and then end up selling that Tesla, this is research via Edmunds, end up going back to purchasing an ICE vehicle. This is a little bit problematic because that aligns with research that suggests the first phase of enthusiast electric vehicle buyers are very different from the next phase of electric vehicle buyers. You have sort of the first 10 to 15% of electric vehicle buyers who say, yes, I want to own an EV. It's sustainable. It's fast. It's wonderful. The control is better. The traction is better. Everything about it is cleaner. The maintenance is better. I love it. I am one of those people. But the problem is the other 85% of Americans have mostly unfounded concerns, but they have concerns, whether it's range anxiety, fires, Elon Musk, whatever it might be. And that makes the next phase of, unfortunately, EV adoption harder. But it's also resale value. A lot of people look at buying, let's say, a Toyota or a hybrid or another vehicle, and they look at resale values and they see, used vehicles dropped on average 6% year over year for typical ICE vehicles. It's actually 6.8%. I thought it'd be funny if it was 6.9, but it wasn't. It was 6.8%. Unfortunately, electric vehicles in the last 2 years are down 39%. In the last year, they're down 21%, which is roughly 3 times the depreciation of non-electric vehicles. That makes it really hard to sell new electric vehicles when people are basically buying into a sinking ship. That's not good. You want to sell a product that seems like it would at least hold up its resale value. Like FSD should hold up its resale value, but it probably doesn't. And frankly, they should, in my opinion, I've made this clear many times already, they should really be plummeting the price of full self-driving to really motivate growth, because Wall Street will reward growth even if margins are slightly lower. We want the network effects of more Tesla, which then drives people to more energy, which in the future drives people to more Optimus, which in the future drives people to more Tesla Robotaxi through the Tesla app. You want the network effects. You want more people in Teslas. You want expanding factories. So get people to buy Teslas. But unfortunately, that's not what Tesla's doing at the moment. Instead, we've positioned at Tesla for, quite frankly, low growth. Fired a substantial amount of service and sales reps, limited the expansion for our existing capacity at Giga Texas or elsewhere. This is obviously for vehicles because, frankly, our growth rate is petering. Now, let's understand this. Before we talk valuation and growth rates and pegs, yes, Shanghai shipments are doing very well. They're up 15% year over year, and so it's not all bad news. It's worth noting as well that lithium prices are plummeting. Even though commodity prices have started recently rising, we continue to see lithium prices fall. And this is a really good thing because even though commodity prices are up about 3 or 4%, we haven't actually seen a bottom yet in lithium prices. And this really helps us with margin as we can manufacture those batteries less expensively, or quite frankly, just buy them from CATL less expensively, depending on which batteries we're talking, Cybertruck 4680s or the LiPo batteries. But before we hit more good, we gotta understand where we sit in terms of valuation and positioning right now. Wall Street consensus estimates for 2025 forward growth for the next 4 years on revenue average 18.9%. That's actually surprisingly low considering the enthusiasm for Tesla Energy. So I thought to myself, man, Tesla Energy is blowing up. Why is revenue guide only 18.9% for consensus? And then I looked at EPS guide, earnings per share, that's bottom line, and that guide is 33.8%, which is substantially better. It's like 50% better than top line revenue guide. And so I thought, why is revenue growing at 18.9 and earnings per share are expected to grow by 50% more, 33.8%? Well, it's because Wall Street is already pricing in energy growth because, frankly, Wall Street is looking at the vehicle business as one that's petered out in terms of growth. And yes, that spectacular mega pack and home battery, high margin energy business is growing, but that's the only thing actually contributing to the EPS valuation that's already being priced into Wall Street consensus estimates. Keep in mind, Optimus doesn't really get much in way of consensus estimates because we don't really actually expect, frankly, Optimus to be commercially viable to the point where it provides a positive return on your investment in an Optimus, probably for another 3 or 4 years or more. And there is a lot of robot competition. It's not like this is, the only robot out there with full self-driving, kind of like the Tesla car in 2017 to really now was. It's frankly that, oopsie doopsie, we actually have a product that will probably end up becoming a commodity, a commoditized robot, I'm not very optimistic about, at least today, pricing in Optimus, unless I could see that we're way ahead of the competition with Optimus. Do keep in mind, I do believe that Tesla has phenomenal manufacturing prowess, but, so do other countries, okay? China, not to mention any names, or even Taiwan, okay? There's a lot of competition for this. But consider this. At today's price, let's just go ahead and take roughly $210 and go ahead and divide that by the earnings per share we're expecting of $2.32 for the year end. We're sitting at about a 90.5 PE ratio. That's really high. That's a 2.67 peg going forward 4 years, and I personally think for a manufacturing company, we should be closer to 1.67. Keep in mind, Tesla doesn't just design the vehicles, they also manufacture the vehicles. This is different than NVIDIA or a software company. A software company or a designer of chips could justify a higher peg ratio because they don't have the burdens of manufacturing, especially in a recession. Manufacturing is extremely capital intensive, which means I don't really love it. But that's why I give it a 1.67 peg, which if we sat at a 1.67 peg today, unfortunately, a 1.67 peg today is only going to give us a valuation of, this sounds terrible, $131 right now, which unfortunately means we have a downside of somewhere around $79 at today's valuations if we wanted to align with that peg. Now, then if we go forward and say, but Kevin, let's go ahead and use next year's earnings per share because maybe this year's EPS is bad or whatever we want to say. Okay, so then let's go with next year's consensus and go with $3.16. At a 1.67 peg, at $3.16, unfortunately, we're still a stock that is worth less than $180, which represents still a 14% downside. Not as bad as the 37% downside I just talked about, but still a downside, making the risk reward for investing in Tesla right now at these levels relatively low for me. Now, I know this is where then people say, but Kevin, you said buy at low volatility at the beginning of June. And this is true. This is exactly what I did. The research that I found said that historically, when Tesla's volatility has fallen to the low it did, which was under a historic vol of 17 on the 10-day, Tesla tends to move up 1.49% per day for the next 45 days. What actually happened was Tesla rose 47% from my pitch of low volatility to both course members and people on the channel. You can go back and watch it. The video's still there. And we rose that level in 32 days before we peaked out, thanks to Elon delaying the 8.8 event, which represented our peak. That meant we actually got a 1.47% return per calendar day. Unfortunately, then I suggested, since we were delaying the 8.8 event and we were going to be closer to having to price in Q3 and Q4 pain, which are the quarters that unfortunately we're going to have to deal with higher CapEx, since we had low CapEx in Q2, and potentially not great growth rates on, sales, and a potentially negative year-over-year deliveries count, which is the current consensus estimate, and even Troy Tesla thinks we're sitting around that level as well. I'm not very enthused about Q3, Q4, especially since if you add to that valuation pressure, the CapEx increase, the deliveries challenges, you add in election risk, and you add in Federal Reserve risk. A 25 basis point cut just isn't going to do much for Tesla because they're already advertising lower rates. You're not going to get more demand when Tesla or when the Federal Reserve cuts rates 25 or 50 basis points. You're going to get maybe slightly higher margins for Tesla, but that doesn't create more sales. And we need the network effects of sales here. So it's not a surprise to me that you have companies like Morgan Stanley cutting Tesla now due to a, quote, continued slowdown in the auto industry, intense competition amongst electric vehicle manufacturers, and reduced consumer preferences for electric vehicles. And this is where I'd like to just bring up that I'm kind of concerned that Tesla keeps trying to dangle this carrot in front of our face that says, hey, but don't worry, we'll be able to license full self-driving to other companies. Honestly, the fact that the Cybertruck has been out for many months now and the Cybertruck still does not have full self-driving, to me indicates that no, full self-driving is not portable to different types of vehicles. And that makes me very, very sad. Now, yes, maybe the Cybertruck is just a niche product and so they're not prioritizing it, which also makes me sad because I really want to love the Cybertruck. But let's just be real. If we can't even get FSD for the Cybertruck, what makes any of us believe that we're actually going to get full self-driving for some other company, be it a Ford or a GM or otherwise? Especially when you have people like Jim Farley saying, hey, whoa, hey, we can make a lot of money in software, so why don't we do our own software? Yeah, that's where the money is. Okay, so now the more advances occur in artificial intelligence-based chips like a Blackwell when that eventually comes out for NVIDIA. I'm not too optimistic about earnings, but that's really a topic for a different video. When that eventually comes out, it becomes easier for people to come up with their own artificial intelligence technology, maybe using the NVIDIA Orin Drive platform where people can basically make their own full self-driving. What you've really done is you've narrowed Tesla's moat from maybe a 5-year moat to a 2-year moat. And honestly, the better chip technology gets, the more that moat compresses and compresses and compresses. So, in the face of valuation, this high valuation, going into Q3, Q4, going into election and recession fears, I am more concerned for Tesla than I ever have been before. It's also worth noting that I have previously said that I thought that Tesla would be recession resilient. And I believe that it would have been a 2022 recession resilient, which is when you have white collar workers who still have their jobs and they're not losing their jobs and they're not going BK because, well, they're losing their jobs. I think people in 2022 would have had plenty of excess cash and the white-collar workers would have had their jobs and they would have been able to continue to buy Teslas. And instead, they would have been able to do so in a recession at super low interest rates. And so you would have driven up demand. I was pretty optimistic about that form of recession resilience. Unfortunately, this type of recession that we might be facing is a lot nastier. The recession that we might be facing right now is a recession that says, oh no, what happens when all of a sudden white-collar workers are the ones losing their jobs and they can't afford Teslas anymore? And then all of a sudden at the same time you get consumer preferences that change and you get an Elon that's a little bit more pro right-leaning who wants an ICE vehicle and less left-leaning who wants an EV. Well, now you're aligning to the wrong demographic at the same time as potentially the New York Times, and I know they lean left, but just put out a hit piece again on X suggesting that advertising revenues are down 86%. And we might be facing Elon selling pressure soon. Remember, Elon promised at the end of 2022 that he wouldn't sell in 2023 and that he might not sell in 2024 if things go well at X. Well, now it looks like advertising hasn't recovered and instead X has resorted to suing past advertisers for boycotting X. And I mean, I hate to say it, but I pay for X Premium $1,000 a month. It doesn't give me anything more than a little Vandy yellow little check mark. Nobody really cares about that anyway. It's not like it makes a lick of a difference to what we're doing, but it's sort of my way of just saying like, hey, I'm here to support you, Elon. Okay, I love you, man. But When we ran ads, at least what my team's telling me, the conversion wasn't as good as what you could get on like a Google or Facebook. And I mean, we rarely run ads, so, consider it just an anecdote. Take it for what it's worth, But these are just things that are at the top of my head. These are just things I'm thinking of. I personally am a fan of looking at the 10/10 event as really probably as well buy the rumor, sell the news. We've seen those plenty of times before. And on top of that, it's worth knowing that, remember, my biggest risk for Robotaxi is with Robotaxi, you need people to have to open up an app and say, I want the fastest ride available. Well, starting now in Phoenix, you can actually book your next Uber with Waymo because they've partnered. And Uber, I think, is now partnering with GM Cruise as well, which, don't get me wrong, I think Tesla's way ahead of Cruise. But I think Waymo, they're on the streets driverless, so at bare minimum, even though if they're geo-fenced, they are a step further than Tesla in that sense, because we still need a driver for those edge case scenarios. But let's just say for a moment that we do have driverless Teslas. We need people to pull up an app, be it the Tesla app or Uber or whatever, and the Tesla has to show up. A Tesla has to show up. If a Tesla doesn't show up, Tesla doesn't win. The way a Tesla shows up is you have to have enough Teslas on the road, or they have to be integrated into an app that people are used to, like an Uber or Lyft. Getting people to go to the Tesla app and download another app, make another account, is a barrier. It's a friction, a pain of paying issue. And then if you open up the app and then all of a sudden it's like, oh, okay, you're going to have to wait 20 minutes for a Tesla, or you can wait 2 minutes for a regular Uber. Yes, enthusiasts will wait the 20 minutes because people love Tesla and that's what enthusiasts do. I would wait for the Tesla, but the vast majority of normal people, they just won't. They're just going to say, you know what? No, thanks. I'll take the fastest vehicle. So that makes me also less enthused, once again, about Tesla Robotaxi. And I'm not trying to sound like a bear. I'm just trying to look at realistic limitations that we have on a potential widespread Robotaxi advance. Waymo, by the way, is now starting to do rides in Santa Monica. Again, I understand. Geo-fenced, it's not as robust or potentially functional as Tesla in dynamic scenarios. You still have people sitting and intervening remotely into these vehicles. I get it. But you're going to need that probably with Tesla as well. And don't get me wrong, the latest versions of FSD, they're great. I love them, and I'm a big fan of FSD. I just think we should drop the price of FSD, get more people buying Teslas, include some of these features standard, and let's expand the network effects of Tesla. You need ubiquity. You want everybody using Tesla and loving Tesla. This probably comes with a balance of some more neutral political commentary as well. But we'll put that aside for right now. So let's just be clear. In 2022, Elon Musk dumped between $25 to $40 billion of Tesla stock, and it really, really hurt to fund X. That may happen again, especially with the pain that we're seeing over at X. Now, yes, energy is a win for Tesla, the energy division, but unfortunately, I think the energy business is already being priced in. On top of that, if you haven't yet seen it, we had yet another VP leave Tesla. This is a person who's been with Tesla since 2013, and she just quit, which is a little surprising to me that somebody who's been there for 11 years as a VP of Finance and Business Operations just quit. Not ideal for Tesla. I don't like to see executive staff leaving, especially as we go into Q3, Q4. So, for those reasons, unfortunately, I cannot be in Tesla at the moment. Would I consider buying Tesla right before the election or going into Q1 of next year, like maybe at the end of January or right before the election if there's a big sale? Absolutely. I love the company long term. I love where the company is in terms of positioning. I do think there are some execution issues that could be cleaned up. I'm not optimistic on the Robotaxi event, and I do think our Tesla mode on FSD is shrinking. And that's why I think we need to get as many people as possible into Teslas and actually bring the company back to vehicle growth and energy growth. Because remember, vehicle growth will also contribute to energy growth. And that way you can get the flywheels of both businesses moving. Yes, in the short term, could reducing FSD to, let's say, free or $2,000 or whatever hurt margins? Yes, but I think it would drive Tesla back to growth. It in my opinion, is one of the best driver assistance ADAS platforms that exist. Everybody should use it. It is fantastic. But I don't think it's being marketed as that. And unfortunately, for the failure to expand FSD and to attract demand, to really promote this demand at this company versus hurting demand at the company with politics, or hurting the share price of the company, which demoralizes staff by unfortunately selling it to Fund X, which could happen again, I'm out. That's on top of the fact that the valuation is very high right now, a 90 PE and over 2.67 PEG. It's too high right now. I think the downside is at least 14 to 38%, if not more, if we go into a recession. Yes, there was a moment where we had some excellent volatility analysis we were able to take advantage of, but today volatility is pretty much mid-range, so I'm not as enthusiastic about volatility now, obviously, because that volatility play is over. It's happened. Now instead we have the bad news of potentially Q3, Q4, a Fed that walks us into a recession, and an election coming up. So I'm not looking forward to it, and I feel really sad because I really like Tesla, but it's just the way it is. Anyway, thanks so much for watching. That's all I got. I just wish you the best out there. Goodbye, good luck, and with the exception of like one retirement account, I have reduced my exposure to Tesla to like 0, and I'm not short. I just have very, very little exposure to Tesla right now.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.